if you're going to come to me as an investor, I have to understand what you're doing, and I have to like that market segment. One of the few things we won't invest in, one woman or one man bands. Just there's too much going on in a startup for one person to. I love working with entrepreneurs. I guess part of it's because I was one myself. I think we do it better than anybody.
Hello and welcome to the Investor Blueprint, where I provide you knowledge, resource, and actionable steps to help you to become investor ready. I'm your host and ally, DeMario McIlwain, CEO and co-founder of Skilldora, and I'm so excited to bring on this guest today. He's a scientist turned entrepreneur turned investor and has overseen over 87 investments into 56 companies thus far. And yet, that's not all. But I'm going to let him tell his story better than I can. So this is that moment where you put the kids to the side, put the dog in another room, and sit back because you're going to want to hear this information. So without further ado, here is the one and only Mr. Eric Dobson.
Oh my gosh, you set me up. No, I got to. Let's see. I guess I grew up in the heartland of America on a farm. Somehow made my way into graduate school. That led me into working for the government. I was a fuzzy-haired scientist working for the government for about 5 or 6 years, and then I ended up basically getting very fed up with the yoke of working for the government, and went as far away from it as possible to entrepreneurship. That was quite an adventure. I don't even know if I knew what the word meant at the time, entrepreneur. So I did this the hard way. Had several companies. The highlights. One was very successful. One was a total disaster, and one was kind of a sideways exit. And that was the last one. And I got invited at that point to join an investment group, and that's where I cut my teeth on the investor side of things. And the thing that I just was shocked about when I jumped sides of the table, we looked at when you're an entrepreneur and someone says, "I don't like the valuation of your company." You think, well, they want a cheaper share price. Okay, I can understand that. You think, but the reality is when you actually jump sides of the table, you realize that that's actually code for something else. It means I don't think you have a big enough market segment to grow into that valuation and give me my return that I want. And that was eye-opening. Suddenly I went, there's a whole different language here. There's a different way of thinking I'm not familiar with, and so I had to really adapt to that. And that's kind of why. And there's lots of more stories, but that's the genesis of this whole concept of becoming investor ready. Is you got two different groups that speak two different things. You got entrepreneurs that speak pitch deck and opportunity and things like that. And you got investors that want to talk pro forma and risk. And until you get them talking the same language, nothing happens. Once you get them talking the same language, magic happens. And so, I'll also tell you that as an entrepreneur, I'll never forget again, just getting my hands on how investors think and the importance of understanding that. So and the other thing I'll tell you is I got into this business because as an entrepreneur, I looked at it and I thought, you couldn't come up with a less efficient way of getting money in the hands of deserving entrepreneurs than we have right now. If you convened a panel of experts, they could not come up with a less efficient system. And so I remember thinking, if I ever get on the other side of the table, I'm going to fundamentally change how capital works, how capital distribution works to entrepreneurs, because what I saw was the ones that were deserving weren't getting attention, and those that quite frankly weren't deserving were getting a lot of love. And that just there's got to be a more efficient system for doing that. And that's I've devoted the second half of my career to that single purpose.
You know what? Thank you for sharing that. But I got to go backwards a little bit because you did a very interesting jump from a scientist to entrepreneur. I would like to think that becoming a scientist, that's a very lengthy path,
It is.
of education and everything. So you basically just kind of put that on the shelf, like those books behind you. You put that on the shelf and jumped into entrepreneurship. What was that driving force, if I may ask?
It's a great question. I always bristled a bit at the sort of the, again, I call it the yoke of academia and just the bureaucracy. I just always bristled at bureaucracy. And I look back and it's kind of interesting. I was always um, a bit of a negotiator. I was always, in graduate school, I didn't settle for the standard, graduate assistantship. I went out and found a grant, pulled it through the university, and lived, lived about twice the economic level of most of my other fellow grad students, just because I was able to put those things together. And I think I just, at the end of the day, and I'll tell you, one big reason was I was working for the government and they gave me a project to work on, and I knocked it out of the park, just killed it. Thought this was going to be a crowning achievement of my work for the government, and they didn't. When they figured out the implications of what I had done, it meant they were going to have to lay off a bunch of workers. Quite frankly, an entire division of the agency I worked for, and because it was going to take their jobs away, and they couldn't migrate. And at that point, rather than admit that they had a technology hurdle to cross and to chart a new course, they just declared the project a failure. And I was very, very, very angry about that. What I thought was going to be a pat on the back became a swat on the backside. And so I said, I was fairly young. I was in my 20s, and I kind of said, to hell with this. I can do this in the private sector, and I can do it better. And so that's exactly that was the first company I set up that was successful. So it was based on that project. So I already had momentum. I already already understood the tech. I knew where all the resources were. I knew exactly. The only thing I needed was a commercial partner, and I got one of those fairly quickly. I just started literally calling companies that had software in the space where I was working, and somehow, some way, a receptionist put me through to the CEO of this company out in Seattle, and I said, "Hey, I do this," and he's like, "Can you come to Seattle?" I said, "Yeah, when do you want me there?" And boom, got on a plane, went over there, having no clue how to do this, having no background whatsoever, just willing to make that leap. And I walked away with the contract. So it was, and it was turned out to be the right company too. So, and he and I have remained friends over the years, and it's been a fascinating journey. But that's, it's part inspiration, it's part faith. You got to make that leap, and that's not an easy thing to do.
I appreciate you sharing that because as you know, I'm a diehard entrepreneur. Um, After I got out the military, I just found out that I didn't fit too well in the corporate sector. Too many rules and guidelines, but not enough innovation was my scenario. So I appreciate you sharing that. But you actually,
I do teach a class at the University of Tennessee, and one of the first things I tell them is that entrepreneur, it's a word from the French. It means lousy employee.
I can watch this. I need to put that on the T-shirt. Lousy
Exactly.
employee. That's a great one. There. That's a great one. Well, it is actually, coming from entrepreneurs, it's a rare case that we actually get to sit and talk for a spell with an investor who's actively in the market. So I'm very excited about this, and there's so many different rabbit holes I would love to go down, but I'm not going to take up too much of your time. But to the benefit of other people watching, I want to kind of go into um basically your passion on why do you like investing in businesses, and being transparent on this channel. We're really trying to target minority entrepreneurship, helping them connect with investors like yourself and things of this nature. But I found out that in my opinion, that a lot of people, I don't know if they have a fear or whatever the case may be. We watch too much Shark Tank and don't realize that 8-minute segment, it was actually 3 hours long. Um, but why, from your perspective, do you like investing into small businesses, especially?
It's a great question. I love working with entrepreneurs. I guess part of it's because I was one myself. Um, Entrepreneurs are out. They're trying to change the world. I mean, every one of them, they've got incredible ideas. They've got energy. They've got drive, vision. It's just fun to work with startup entrepreneurs. I just love every minute of it. Sadly, it's one of the few things I don't get as much time to do that as I want. There's paperwork and all sorts of other things that deal making, it gets in the way. But I just love working with the passion, with the inspiration, the vision, and helping guide that, because if you don't set a solid foundation, you can't be successful. And there's so many um, loud but uninformed voices yelling at entrepreneurs, that it's. I really want to be a voice of experience and help these companies set off. Because if you catch entrepreneurs in the early stages before they develop bad habits, you'd be shocked how much more efficient you can grow a company. But the opposite is also true. If you develop bad habits and you make too many mistakes, it's hard to overcome that. And I don't think. Well, it's also, again, a cornerstone of our economy. Let's say almost all jobs. Bureau of Labor statistics show that something like 90% of all jobs created in our economy are created by small companies. Right there. I believe there's an urban-rural divide that we have right now that I think it may not have been as pronounced certainly in modern history. It's never been this pronounced and stark. I mean, you just saw this recent election. The heartland basically said, no, we're done with this nonsense. You've kind of left us out here to fend for ourselves, and we're done with it. Okay, so I believe there's a future in rural America, especially with minority companies. I believe there is a renaissance of science and technology out here in the real world, outside of the New Yorks and the Silicon Valleys and all the hullabaloo. I believe we can all make a major impact in bringing economic resiliency back to the heartland of America, because the intellectual property is here, the entrepreneurs are here, everything we need is here except capital and good leadership from an investor standpoint. And there are some great investors. Please don't take that the wrong way. We just need more of it out here.
Well, you are, as my wife would say, this is a safe space. So when we are talking about investors, like I said, with my history of being out there for a while, I've had my share of conversations, some shock and awe conversations, and now with the information, thanks to you, as I like to throw that little plug in there, Eric has been a great friend to me. I like to call him my mentor. He actually inspired a passion. Just inspired a deeper passion in me to actually want to help more entrepreneurs connect with investment capital. It's not a selfish thing, because I really do believe in what he's talking about, as well as I want to see people win. And I understand that no, or that not understanding, it hits hard. I know firsthand. So I really appreciate this opportunity. But I want to go back to something that you was talking about, and you was talking about catching basically a founder when they're in the early stages before they create bad habits. So that is a great segue into this question of, what do you mean when you say early stage? Because a lot of people ask that question. What do they mean by early stage?
Sure. I typically mean seed stage deals. So not pure conceptual. Nobody really invests in purely conceptual companies. But if you've got a business plan, a credible business plan, and you're able to build some credible financial projections on it, and you've got some kind of prototype of your system, your product or your service, we're willing to start talking. I mean, we may not be ready to invest yet, but we're ready to get to know you and figure out if you're one of those transformative entrepreneurs that can go from 0 to 10 or and hopefully 10 to 100, whatever that looks like for you in your business and your market segment. But that's roughly when we'll get involved. So probably 50% of all the investing we do starts in a pre-revenue company. So we're very good at working with pre-revenue companies. That's also why we've structured our whole model is based on basically working with entrepreneurs. Like I said, we'll engage early, and then we got to figure out if you're truly investor ready or not. Once you're investor ready, we have an angel group process that we go through, and we'll invest 2, 3, 4 times, whatever it takes, as long as you're being smart and making all the growing your sales and doing all the smart things. That's our de-risking process. We call it building dwell time with these companies. We get to know you. We know how you take money, how you spend money. Basically what your priorities are, roughly when you're going to exit, who you're going to exit to. At that point, we've taken most of the material risk out of the deal, and then we've got a larger fund, so we pull those companies into a venture fund, which sits on top of that. And so we can scale. I guess what I'm trying to say is, from contact to exit, we can scale our investment with a company so that we stay in longer. We take more. We basically continue that mentor role. I think you called it mentoring, coaching. We can scale with the companies that we select. We can also engage with companies just about anywhere on that path. About 50% start pre-revenue, which by most people's estimation is pretty darn early.
That's a game changer right there, because a lot of information that you get out there from small business perspective is that they're looking at that bottom line revenue of X amount of dollars, seeing a lot of traction. So that kind of scares people off and say, hey, I'm not quite there yet, but I am here. And I think this is where the bad habits happen.
Oh yeah, that's exactly
what you're talking about.
Yeah.
But I wanted to kind of go backwards a little bit. If I'm not mistaken, you created a very unique situation when it comes to the collection of angel investors. You call it a syndicate.
Right.
Could you talk a little bit about that, please?
Well, I'll see you go backwards and raise you one. Our network, I joined in 2012, but it was actually founded, it was female founded, and we've never really forgotten that. That's one reason I think I think about probably 15% of our investments are in women founded companies. Yeah, this was really her idea. Our founder, her concept was, rather than trying to build relationships with disparate groups when you need them, just to build that over that sort of that umbrella over the whole network, multi-city syndicated angel group. And it was brilliant. It worked, and it still works today. And the nice thing is, it's part of our DNA. So every time we create a new group, we're in expansion mode right now. So we're going to new cities and opening up new angel groups. The model is that each of the groups, and there'll be anywhere from 20 to 50 investors in a group. Each of those groups acts semi-autonomously until they find a deal they really like, and then it comes up to the umbrella level and work on it as a network. So we call all of our members that have expertise. We round up capital from our entire network. We share the lift when these companies need something. We share that lift. So the syndicate, the beautiful part of it is that basically, if you want to do, let's say you're in Knoxville, Tennessee, where I live. Okay, you've got companies coming at you for cash, and you want to do, let's say you want to invest in 10 great companies a year. One angel group cannot take 10 investments per year and fund them through exit. It is just that the economics don't work. But if you've got a syndicate of groups, when one starts to take off, everybody can support that company, and it really just ends up being to a certain extent, kind of Darwinian process. Don't get me wrong; it's a beauty contest. It's the prettiest girl gets all the money. But at the end of the day, the syndicate can support such a broader, longer process and be more patient with its capital than a single group trying to invest in 10 local deals right here. I'm trying to drive them all. We just find it to be a much more efficient system. The other thing you'll love about it is that we talk about early stage companies. I've got a couple hundred members. It's not hard to find 10 that want to put $5,000 into a seed company. Okay, Yeah, exactly. And then I've got more investors that, they don't necessarily like seed deals. They like the next stage or the next stage. And so as these things grow, uh, as the company grows, so can the investment. That's the kind of the model we've developed. So that's why I say a syndicate is so important, because especially it's just talent, it's resources, it's like-minded individuals, just doing great things.
That that is a complete ecosystem right there.
It is.
As you was talking, I was just imagining, from a business perspective, once you get inside of this pool, the resources and availability to scale and grow faster because of the different resources. Oh man, I haven't heard anything like that before.
And we
That's
haven't
crazy.
either. There's I don't know of anyone else that's doing this. I mean, so other groups are quote unquote syndicating, but I don't. I think we do it better than anybody else. Let's just be. I'm just going to be
Oh
shameless
yes,
about that. I
yes,
think we do
yes.
it
Go
better.
ahead, go ahead.
Yeah.
Yes. That's great. Well, these are great things, and I really appreciate what you're sharing here. I wanted to now take a little deep dive, because I know some business owners are listening, and they're saying, "DeMario, you need to get to the meat." I understand. I hear y'all. I hear y'all. So, let's talk about the founder, for instance. Of course, I read a lot of your information, even your trainings. And one thing that you talk about that I really like, you talk about the investment into people,
Yeah.
beyond, the documentation and things of that nature, kind of looking at the people. So, if you could, what are some key qualities do you look for in a founder before you decide to invest?
Great. Oh gosh, that's a great question. Okay, so founder qualities. I want to say one thing before. I've started this actually started from I guess a presentation I made 5 or 6 years ago in West Virginia, but I always have these pithy little statements that were dubbed Dobsonism. So occasionally you're going to have hear a Dobsonism. This is one of them. People invest in people in markets they like and understand. So if you take that apart, it's investors, people, investing in entrepreneurs, people. So you got to that's that person to person connection is the most critical of all the relationships there. But if you're going to come to me as an investor, I have to understand what you're doing and I have to like that market segment. And if either of those things is not true, it doesn't work. And that's why you see so many entrepreneurs pitching at the wrong time to the wrong investor with the wrong pitch. And that's a big problem. Now, so what qualities are we looking for? Obviously, resilience. I mean, this is you got to on your worst day, you got to pick yourself up, dust yourself off, and get back in the fight. I mean, it's just hands down. It's you got to. We have to feel that you as a founder are resilient and you're committed to it. We like to see obviously founders. You got to have skin in the game. Um, we can't be your only resource. You've got to put your own resource in and be all in. Coachability. We want to see confidence, not arrogance, but we want to see confidence, but coachability, ability. Because, by the way, I've got 40 or 50 more investors behind me that have been entrepreneurs in their career, and they all have great stories to tell. They all have great wisdom to share, and that you've got to be able to tune into that. Not only just listen to it, but seek that out. You got to be someone who's constantly learning. Um, what other characteristics? Sales. You've got to be able to sell something. One of the things that I always tell entrepreneurs: the first time you approach us, we get to see how you market and sell, because selling me shares is no different than selling products and services. Period. So this is a sales activity, pure and simple. If you don't know how to sell shares to me, there's another Dobsonism. If you can't sell me shares, you probably can't sell products and services either. So think of it as a sales process. You are marketing to me. You are selling to me. You have fulfillment issues. It's a sales job, and I want to see an entrepreneur that can do that. The other thing I'll tell you is one of the few things we won't invest in. One woman or one man bands. Just there's too much going on in a startup for one person to. I mean, yes, at the conceptual stage, I get it, but when you're ready to start taking investment, you have to have a team, and that team better include, and it can be two people. Don't get me wrong. We're not saying you have to have a full team, but you can't afford them anyway. and you'd probably be putting B players in the spaces if you did. So, but we need to see at least two people. But you got to have an executive who's really ready to be that front person out there, out there meeting people, telling the story, building, showing the vision, building the community, the tribe, whatever you want to call it. You've got to have somebody that understands the tech in-house, pure and simple. You can't be outsourcing all your tech development. You got to have somebody that's coordinating that inside. And the other one is you got to have somebody that knows how to market and sell. Those can be two people. Don't get me wrong, but those three characteristics, those things have to be covered in a management team before we're going to get involved. So that's another challenge we see is a lot of great entrepreneurs come to us and they say, if you give me money, I'll bring in the team. That's part of that nasty first step leap of faith. You got to find somebody that's willing to buy into your vision with you, because that's the first sales marketing kind of thing that happens is you've got to sell to the people on your vision. And I'm fond of saying there's actually an entrepreneurial sales cycle, which is essentially you sell vision, then you sell shares, then you sell products and services, then you go back to selling vision, then you go back to selling shares and products and services and back until you either sell your final shares and exit, or you don't sell enough products and services and you crash. And that's most people don't realize this is it's a circular process.
You know what? That was great, because now that just makes me want to ask the question that I heard you kind of answered it, but I want to pull it out a little bit more. Okay. So yes, I'm a business owner and I want to gain investments to hire a team. Is that correct? I know now, let's say you're at two people. Can you use an investment to actually staff up the rest of your weak spots?
Yeah, in fact, we expect you that. But as a one woman, one man band, if you tell me, well, give me all your money and I'm going to go hire a salesperson or whatever. I mean, no, that's not going to fly. But yeah, if you've got those three elements covered and you say, yeah, and we really need a lead engineer and I'm going to use part of this money to hire a lead engineer, great. If that's what you have to do to get to your next milestone, and tie everything to how it will change your valuation. And in other words, or commercial traction, another way of saying that. Tell me exactly how hiring this engineer is going to get you to a point you can do a pilot project with your first customer, which will change your valuation materially. Okay, so if you relate that back to value to me, I'm always going to be happy about that. If you tell me all you're going to do is go buy, you're going to buy an office building, not really. That doesn't really add value to this at this juncture. You may one day want to buy a building, but I don't care if you own real estate right now. In fact, I don't want you to own real estate. I want you to invest everything into your people and your product and your marketing and your sales.
Are you ready to elevate your business and secure the investment needed for growth? Whether you're launching a startup or expanding an established business, this course will guide you through the critical steps of raising capital. Welcome to the Investor Readiness Certification Program by Skilldora, where our mission is to empower minority business owners with the essential tools and knowledge to attract the investments you deserve. This program is designed to give you step-by-step instructions and actionable templates, so you can confidently move forward and secure the investments your business deserves. Once you've completed all the necessary steps, you'll be ready to submit your business to our Investor Ready portal. Let's get started on your journey to investor readiness. Enroll today.
I just did a talk recently. I asked them, did they want me to deliver this presentation like a Sunday morning worship service, or did they want the DeMario style where I put on my hat and I was just really talking the way that I was talking? And I was talking about the aspect of from what I'm learning is everything that you put into your business when it comes to the investor's eyes is you're putting it in to actually move the needle. Every person, product, service, whatever the case may be, everything has to be leading towards driving profits,
Yep.
scalability,
Well,
and things
commercial
of this
traction.
nature.
Yeah, exactly. Yeah, customer traction.
But Eric, the one thing that I'm starting to find that I actually have a lot of fun talking about myself,
Hmm?
and I want to kind of entertain this with you, is I call it deal killers. The theme music should play when I say that, deal killers, dun dun dun. I was studying the back end of Shark Tank, and I found out that 43% of the businesses that they even say yes to on camera fail through that two-letter word, or I mean a two-word phrase called due diligence.
Yep.
And if you could, I would like you to first talk about that initial due diligence. Like, okay, here somebody uploaded their information onto your site, or however this information got to you. What is that next step from your process?
Yeah, good question. Okay, so I mean, diligence. The literature actually literally says if you spend 20 hours of diligence on a company, just 20 hours worth of investigation, you are 500% more likely to get return on your investment. That should tell you something pretty quick. That most of the problems are fairly obvious, and they're up here. They're not way down here. But when you do a full diligence, you get to those. But at the end of the day, we can eliminate a deal in minutes based on what we know, as you said, deal killers. Okay, there's a bunch of them hanging out there, and we probably ought to publish a blog on that. And I'm sure probably have it someplace already written. But anyway, at the end of the day, yeah, due diligence. Okay, so first things first. Obviously, we're going to want just a little information from you, and we're going to do some pre diligence on you. We're going to look up, your social media profiles. We're going to look up your state registration, because there's a famous story. Earlier in my career, I watched a company that had a brilliant piece of pharma technology. They had an enzyme that would turn any blood into universal donor blood. So big deal. They were literally at the table to be acquired, and one of the other lawyers looked up and said, "We can't find your Delaware registration." The company had basically forgotten to file its Delaware state registration for 5 years. What that really, and they had filed patents, they had issued contracts, they had been administratively dissolved. They were not a functioning company. They were not a duly organized company. And so literally the first thing that happened is the board stepped in, the CEO got fired, new CEO came in. They finally got the thing righted, and they sold it, I think 2 years later, for half of their original offer. Okay, so just simple stuff like your state registration is, and I get it. I mean, there's more paperwork on small businesses than there should be, but there are a lot of structural issues that can really derail. So we'll do a little bit of that. Obviously, at that point, we're going to do some internal screening. We have our members screen and tell us what they like, what they don't like, and it's pseudo quantitative. Obviously, there's a scoring system, but at the end of the day, one of the questions is, do you want to pitch this company or not? And that can be based on any number of things. We want to see. We like to see a 5-year pro forma, not because we think they're accurate. In fact, we know they're not. We know the one thing we know about all financial projections is they're wrong. But how you plan a business and how you plan to grow a business are very obvious in those financials if you pick through them. So we like to see that a lot, because the financial projections are just a numeric version of your business plan. And your business plan is just a written, it's just a prose version of your financial projections. And if those two things are in lockstep, we're pretty happy. At that point, we say, okay, there's another Dobsonism. If you can't plan a business, you can't run a business. So at least we can see that you can plan a business, and that gives us a lot of hope, because we're dealing with big picture risk. We're trying to take big picture risk down to small picture risk, the known and knowable risks. That's what we want to find out. So let's deal with the known and knowable risks. And if those are small enough, let's move ahead. Let's get hitched. Okay, after the screening part, we go through a pitch, and so that's when we meet you, we get to know you. We're a little weird. We like to look at the deal first. I'm going to be perfectly honest. And people will tell you, bet the jockey, not the horse, and the jockey being the entrepreneur, horse being the company, track being the market. So bet the jockey, not the horse, and certainly not the track. But at the end of the day, if you don't like the deal, don't do the deal. And I hate to say that because everybody wants to say, oh no, it's all 100% is just I invest in entrepreneurs that smart ones will figure it out. Yeah, I get it, and we do. We've seen a lot of pivots. Sometimes those have been successful, sometimes they haven't been. But if you don't like the deal from the start, don't do the deal, and we don't. So that's one way we're weird. So we do the pitch. We actually go out to our members at that point and say, tell me how much interest you have, monetary interest you have in this deal. If we get at least 50,000 investment and notional commitments, so we call them soft commitments, then we go ahead and do the full dive, the full diligence dive. We'll do 40 to 60 hours worth of work digging. So it's pretty thorough. I mean, it's I'm not gonna lie about that. It's a thorough digging because the one thing we know is that there is a 90% chance a startup will fail in 5 years and a 95% chance it'll fail in 7 years. So you gotta, I guess that this is both a challenge to the entrepreneurs and sort of a explanation for the investors. We're looking for that last 5%. Those are the companies we're looking for, and that's not 5% in a, pick a company in my backyard. This is, yes, I want to pick those companies in my backyard, but they've got to be 5% of the total at the end of the day. Now we have some other. That's for the venture side, obviously. We do have some other investment processes that allow us to invest in lifestyle businesses that have growth potential. So you don't have to be a unicorn $1 billion exit to get an investment. If you've got a smart group of investors, there are ways to structure some of that so that we get a suitable return at a lower risk profile, okay, versus the big risk profile, because I'm sure you've heard the math. For every 10 investments you make, 4 to 5 are going to go belly up, 3 to 4 are going to return the capital you gave them, and it's that 1 to 2 at the top end that pay for everything plus profit. And so that means every single company you need to invest in has to have some minimum ability to return capital. So the big risks means you got big returns. So if you can give me a lower risk deal, we can take lower returns and still get you where you want to go. So I think flexibility in our process is critical. We developed that over a long period of time because we found this problem, especially out here in the heartland. There are a lot of great companies. They don't necessarily want to be sold or IPO. So why not come up with another structure so they can be successful and we can benefit in helping them. So I think I went round and round and roundabout. But anyway, the whole point is we get to the diligence process. Then we do basically a company at that point is a quote unquote check ready deal. And we put that out to our investors kind of as such. Here's the diligence plan. Here's all the files. Do your own research here. But at the end of the day, we've gone through this process and we think this is a better than average bet. And then we make the investment. And we do that as one syndicate. So we round up all the money and all the investors. We put them into one legal entity at the last second, and that entity invests in your company. And you only have one person to deal with. Granted, it's me, and he can be a bit overbearing, but you only have one person to deal with once the deal is closed.
Thank you. That was some key points there. I hope everyone is listening, watching. They took some notes, rewind it, listen to it again, because I am. But you would be proud of me in the talk that I told you about that I had. I actually quoted a couple of things that you just said.
Oh, there you go.
And I gave you the credit as well. So I'm learning very well here. But one thing I did not realize is that there are investor structures out there for lifestyle businesses or people who don't want to exit. I just thought that for every investment that you take, the forecast or the outlook is for you to exit. I didn't realize that there was scenarios that could be different from that.
Yeah, it's called revenue-based investing, and you'll see the smart people are doing it now. It's more or less you can do it in a royalty style deal, or we do it what we call revenue share investing. So, we basically loan the company money for growth, and they get some period of like a year of grace where they don't owe us anything. And then for a period of 5 years after that, they owe us some percentage of gross revenues or something that we work out, so that the company, that tends to be over a 6-year period, it's about a 3x return. And it's good for us, but that means we have to have confidence that you have enough commercial traction that you can take that money, grow to a certain point, and then fulfill that obligation out there. So yeah, at that point, we don't sit on your board. We don't own a share of your company. We are not shareholders. We trust you to ride. We're riding along beside you, and we put in growth capital. So again, that means you don't have to have an exit strategy. You do not have to plan for an IPO. You do not. If you get bought, great. There's a buyout clause in there. If you get purchased, wonderful. Congratulations. Maybe you probably made life-changing wealth. Good on you. And we still benefit at that point, but we want to, obviously.
You just blew my mind on that one. Like, I'm really, like, I could literally hit the stop button and just walk away with that information alone, because yeah, that information right there, that speaks volumes, because of course, I've been out here talking to a lot of business owners, especially with our investor readiness program. And I think some of it, I try to pinpoint the fear. I can't say that I understand all of the dynamics to why some people are hesitant when it comes to taking in capital.
Yeah, well,
but
it'd be intimidating because there's very little good information out there on the process.
Yes. But you know what? When you're talking about exiting, I know that is one thing, because a lot of people, they create these businesses, they want it to stay in the family unit.
Sure.
They want the kids to take over, and it's like, oh, I can't take on this money. And you just said basically no equity.
Yep.
Revenue scenarios. You're basically investing in the growth and getting your residuals off of that total process right there. That's beautiful.
Yeah, there's no reason to be intimidated by it. Don't be afraid to ask questions with the right people. I'll tell you, when I took over the Angel Group, I was in charge of the deal flow work before I took over, and I would actually tell companies why we were turning them down in detail, and people around me were going, "Oh dear God, don't do that! No, you can't tell them why we're saying no." I'm like, but if we don't, they'll never get better. Why would we not do that? And they're like, oh no, they're going to get defensive, and oh, this is going to be awful. What are you doing? And to their credit, about 1 in 100 becomes somebody I have to block, cinder, and mute, and not, block on phone, things like that. But the other 99 gush with thanks. Oh my gosh, thank you for finally telling me why no one's investing in my deal. And so that's been, to this day, we've got a diligence analyst, young man right now, and that was one of the first things I told him. Nope, you're going to tell them exactly why we're telling them no, because if you don't, no one will. And so that's, again, you got to find the good voices in this industry that especially ones that have been on both sides of the table or the ball, whatever you want to say. That's really a big difference.
I love that. And I just want to ask one more question towards that. So with that information, let's say you do have a deal that goes through, and it's a no today because of X. Do that company also have an opportunity to return back to you, like stay in the network and come back, especially if you telling them what was wrong, they're going to go out and fix those exact things and want to approach you again.
Yeah, absolutely. Yeah. We always say no. Please feel free to come back, unless it's just a market that we just don't understand. Like, we don't do real estate investments. We don't understand. My members love investment. They do their own investments in real estate. I'm a tech guy. That's why they come to me, is for tech deals. So if you come to me with a real estate deal, again, this is like and understand. I do like real estate. I don't understand how to do it. So I don't. So there you go. That's part of that original Dobsonism there. Yeah. So it's just about that give and take.
So with that, yes, you just said you're a tech guy. So far as in the deals that I realize, probably tech is on the highest of the totem pole, but are there other types of products, services that kind of tickle you even if they're not quite tech?
Yeah, no, there's some tech adjacent spaces. I mean, we've got a consumer product or two. We've got a company that makes almond, basically almond snacks. Okay, so we've got some consumer products, CPG products in the portfolio. Nothing wrong with that. We understand how to do that too. Um, so nothing's stopping that. My passion is tech. My history is tech. I just that's and people come to me for that because they apparently think I know something that they don't, and I don't think that's true. But
So is this high end tech, or could you kind of describe when
yeah,
you say tech?
yeah.
What does that mean in your eyes?
Yeah, we tend to excel at more of the deep tech, clean tech, hard tech, med tech, some of the deeper stuff, the strongly IP backed stuff. About 80% of what we do is probably, I would call strongly IP backed tech. But the other 20% is, fintech, where you see little or no, intellectual property, software as a service, AI. I'd put AI in that category. It's not, there's rarely intellectual property to gather around that. Although we have one that did. I mean, one of our companies actually has a pretty amazing IP suite around that. So that's one reason it was easy for us to do. Um, I mean, again, there's nothing wrong with those companies. Most of the non-IP companies, the challenge is it's a land grab market. Usually, it's not something. They're rarely creating a new market. It's that they found a better way to do something, and that they've got to just move incredibly quickly. That also means it's fairly expensive. So if you've got to move that fast and you've got to pour that kind of money into marketing, it's going to be expensive, and it's an all or nothing proposition. So it's just a little harder to do. Um, not at all impossible. We've got several investments in companies that don't have any quote unquote IP or quote unquote they're tech tech adjacent. They're not quote unquote technology. So there's nothing wrong with that. It's just that's kind of what we do.
That's great. That's great. Well, like I said, I'm not going to hold you long, but now I want to get into what did you say it's called? Dobism? What's that
Dobsonisms.
phrase? Yes. So, here we are. We're moving into the 2025 year. New things are happening. Quote, quote. Uh, the economy probably is going to shift a little bit.
Mm-hmm.
What is your insight on investments being made, especially in next year? Do you think that's going to change? Is the money going to kind of shorten up a little bit, or you?
Yeah, interesting thing. For the last 2 years, with coming out of COVID, there were some there were pretty 2020. Like I'll go back to 2020 for a second. Nobody was angel investing in 2020, and we were barely hanging on. I mean, we had no operational revenue for 8 months of 2020. I mean, we weren't meeting. We were getting some polite inquiries from companies, but everybody was just standing back going, I don't know what's about to happen here. So I mean, there are big picture perturbations of these things that cause contraction of the market. There are things that happen. So coming out of COVID, I think we saw initially a kind of a growth towards tech investing, and then everybody sort of hit the election cycle, and everything went back to the sidelines. So there's been a lot of pent up energy and a lot of dry powder sitting on the sidelines for the last 2 years. And I believe, regardless of your opinion, Democrat, Republican, doesn't matter. There's an expectation right now that the markets are going to rally, and they weren't that bad to begin with. Quite frankly, that's the irony. They were actually doing well. So you've got of course the recession that never was, all that kind of fun stuff. I think I think there's going to be a lot of money coming back into the system in 2025. It has to. Money has to go to work. It can't sit on the sidelines for long. It has to go to work. And it's been sitting there for quite a while. It's been perched, just sort of waiting to fall in. So I think you're going to see a very healthy, aggressive market in 2025, is my opinion. And again, this is not a political statement at all. I just think there's been a lot of it happens every election cycle. Everybody goes to the sidelines, waits for the melee to finish, and comes back to the market. So I mean, it would have happened regardless. Doesn't matter. But my point is that there's been a lot of money sitting on the sidelines, and it has to go back to work. And I think it's going to go back to work in early 25. So I think it's going to be a good time to raise capital in 25.
I'm feeling the same way. I'm glad you
Yeah,
said that. I'm
there's
feeling the same
there's
way.
an optimism in the heartland over this. And again, this is not a political statement at all, but perspective and outlook are everything, because let's also back up and say for a second, the equities markets are all pure speculation. That's it. They are based on pure speculation. So your outlook, society's outlook, the society's engagement, all that stuff feeds market success. So
This is great. This is great. Well, I tell you what, I could actually talk to you for hours, but I will not do it. And it's 1,000 questions that we could go through.
and we can always do it again.
Especially, yes, sir. So in kind of in closing, I know we talked about these things in a big overview, but we're really pushing investor readiness. And I would like to say that you are the creator, especially of this curriculum that we are using when it comes to, helping get that same language going on between the small business owner and the investors. So, in a nutshell, when you saying investor readiness, is that basically all of the things that you was talking about earlier? The right team, the documentation. Is it any other thing outside of that just kind of comes to mind when you say, I want you to be investor ready?
That's a great question. There's a lot in there. So much of it is basic information. We just need to coordinate. Because I think, again, entrepreneurs want to talk pitch deck and investors want to talk pro forma. I mean, it's just getting understanding, everybody understanding the other's perspective for starters, getting on the same page. Beyond that, again, I mean, the biggest thing about this is, and that whole investor curriculum originally was designed to go to for the nerd, for the uber nerd who's out there doing something that nobody even understands, but it will dramatically benefit humankind. And so that's where all that came from. Yeah, the missing link in there, I guess, is for the uber nerds, marketing and sales is really, really, really hard. So they tend to be in markets where they do highly technical sales. So nerds selling to nerds, great, that's easy. It's the nerd to human, or that's the challenge, I think, and that's why I think what we're trying to do now with the investor readiness curriculum is broaden that. So it's not nerd to nerd, it's nerd to human or human to human. So that, to me, that understanding that process of marketing and sales is so important, again, because this is fundamentally a sales job. Selling shares of your company is fundamentally a sales and marketing job, period. So the more entrepreneurs understand that relationship and embrace it, the better off they're going to be and the more successful they're going to be.
Cool. And one other thing, when it comes to getting an investment, LLC, or do you have to be C Corp or what have you?
We can talk about that for a long time too. You need to be as LLC or a C Corp, and more commonly now it's C Corp. What you'll see, 20 years ago, nobody invested LLCs. And then suddenly, about 10 years ago, people started investing in LLCs. Maybe 15 years ago. The challenge you've got is, of course, that stuff you can do every day happily in an LLC, you go to jail for in a C Corp. And that's why most investors really like it. It is the stronger governance, much more regimented business, gazintas and gazautas. And then, the other thing is you don't generate any tax events between investment and exit, unless they give a dividend, which is pretty rare at this end of the market. Don't get me wrong. So, one of the things that, and we deal with it every year, I've got 57 companies that we've invested in the last 15 years. And some of them, most of them, the older ones are already gone. Don't get me wrong. But the point of it is there's still tax documents that come along. And the way we deal with everything is one holding company, one investment fund, essentially. If one of those companies is late with giving me tax documents, I'm late giving my investors tax documents. And that can be very frustrating for a lot of, the good news is if you're in an LLC, The tax treatment is the investors start getting their money back every spring. Okay, because you start taking losses while the company's building. So the investors start getting their money back until the company starts making money, and then typically the investors force the company at that point to become a C Corp. So they get to stay away from what we call unfunded gains, which is really the risk of the LLC. You can make money as an LLC, but if you don't pass that to your investors, guess what? We get a gain on our personal taxes without cash from the company, and that's not going to last long. People get really angry about that. So, I mean, you really have to. In fact, we had a company in our portfolio last year merged, and for the short-term tax implications for the merger were better off served as an LLC. He'd never run an LLC, so I called him on like March the 10th. And I've been emailing him. March the 10th, I called the investor, the founder, CEO. I said, "Hey, where's our tax document?" He's like, "Oh, we don't. What do you mean tax document?" I'm like, "You have to give us a K1. You're an LLC now. You have to give us a K1, and by law, you have to give it to me by next Wednesday." And he's like, "What? Like, what do you mean what?" I mean, and so he literally, I mean, you heard he just about sucked up the Naugahyde seat chair when I told him what was happening here, and it's a seat cover, and I felt bad for him, but he literally had to drop everything he was doing, go and badger his accountants and get them focused on getting all the tax documents ready, and he still didn't get me a K1 until October.
Oh,
so
wow!
I had some investors last year that didn't get their tax documents until October, and that's why people hate LLCs. But they're great. Again, it's just whatever game you want to play, and whether or not your investors want to get their money back early, or they want to, there's just. So, I think more and more you're going to see C Corps are the standard, but but it's just my opinion.
I got you. Well, I'll tell you what, I want to close this out. You've given so much great information, and I just want to close this out with one thing.
Okay.
What is one thing that you wish all founders knew before approaching investors like you?
Yeah, a couple of different ways to look at that. One of which is build relationships before you need them. The other thing is don't wait till the 11th hour to call me and tell me you got a problem. I get that. Hey, I need money in 3 days. I can't get you money in 3 days. That's not going to happen. So, I think it's probably maybe I sum it up with transparency. Just, if you've got a risk that's a pronounced risk, go ahead and tell me about it and tell me how you're going to deal with it. We know you've got big picture risk issues. Just if you help us out understanding your situation, again, the known and knowable risks, the better off we're going to be. Just be totally transparent. There's no reason not to be. So
I appreciate that. Well, Eric, it has been a pleasure talking with you. And of course, we're going to do this again. Like I say, you got my head spinning now with the information that you just shared, and I can't wait to go back and listen to it myself. So therefore, like I say, I'd like to thank you for your time and all the information that you have shared. For everyone that's listening, just when you go on YouTube, just type in Eric Dobson. He's got a lot of videos out there, a lot of interviews where he's just dropping nuggets one over one. I'm a fan. So therefore, that's what I want you to do. So other than that, Eric, I really appreciate your time, and we will talk to you again soon.
Great talking to you.